Okay, so you know how we're always trying to figure out the best ways to manage our money, right? To really feel like we're in control and building a secure future.
Absolutely.
But sometimes it feels like there's just so much financial advice out there that it gets kind of overwhelming. You know what I mean?
Yeah, totally.
So for this deep dive, we're going to really break down a fundamental decision: saving versus
That's
investing.
yeah, a big one.
Because it's one of those things everyone has to deal with at some point.
It really is. And it's often framed as this either or kind of choice.
Right,
But the
exactly.
material we've been looking at for this deep dive makes it clear that a more nuanced approach is usually the way to go.
Makes sense.
So today, we really want to dig into the core differences between saving and investing.
Okay, so what are we actually talking about when we say saving versus investing?
Right. So we want to help you really assess your own financial situation
Yeah.
and figure out the best times to focus on saving versus investing. And we're going to base all this on the insights from Should You Save or Invest Your Money.pdf.
Perfect. So let's get into it.
Sounds good.
The source material really emphasizes the main purpose of saving, right? It's about protecting your money,
Yeah,
making sure it's there when you need it
exactly.
for those planned expenses and, those unexpected things life throws at you.
Right. It's like your financial safety net.
Exactly.
And the tools that we usually think of for saving, they're all designed for that purpose.
Makes sense. So what are some examples?
Well, you've got things like high-yield savings account,
Okay.
where you earn a little more interest than a regular savings account.
Right.
Then there's certificates of deposit or CDs.
Okay.
Those offer a fixed interest rate for a specific period.
Okay.
And then you've got money market funds.
Mm-hmm.
So the big advantages with these are they're super low risk, especially with the FDIC insured accounts.
Right.
And it's easy to get your money when you need it.
Yeah, that makes sense.
Good.
But there's got to be a catch, right?
Well, yeah, there is a big thing to consider.
What's that?
While your money is safe in these accounts, the returns you get are usually pretty small.
How small are we talking?
The document mentions a range of 0.5% to 5% APY.
Okay, but what does that actually mean for my money?
Well, this is where it gets interesting.
Okay.
Even small amounts of inflation over time can actually make your savings worth less.
Oh, wow, really?
Yeah, so you might have the same amount of money in your account,
Right.
but it won't buy you as much as it used to.
So, if I have $100 now
Mm-hmm.
and inflation is, let's say, 3% per year,
Right.
in 10 years, that $100 might only be enough to buy what costs $75 today.
More like $134, actually.
Oh, wow. Okay, so it's my savings are losing value if they're not growing at the same rate as inflation.
Exactly. That's a really important point.
So how do we combat that?
Well, that's where investing comes in.
Okay, so what's the main idea behind investing then?
Investing is about growing your money over the long term,
Okay.
not just keeping it safe. It's for those bigger goals, way down the line, like retirement,
Yeah.
paying for your kids' college,
Mm-hmm.
or buying a house.
So how is investing different from saving in terms of the actual things you do?
The tools are totally different.
Okay.
We're talking stocks, which are pieces of ownership in companies.
Oh, yeah, I've heard of those.
Bonds,
Mm-hmm.
which are basically loans to the government or companies.
Mm-hmm.
Then there's real estate,
Okay.
and then things like ETFs and mutual funds.
Yeah. What are those?
Those are like baskets of different investments.
Oh, okay. So it's not just one thing.
Right. An ETF usually tracks a specific index like the S&P 500.
So you're investing in a bunch of companies at once.
Exactly. It helps spread out the risk.
That makes sense.
But the really interesting thing about investing is the potential for much higher returns.
Higher than those savings accounts we talked about.
Oh, yeah. Way higher. The material mentions average annual returns for stocks of 7 to 10% historically.
Wow, that's a huge difference.
It is,
But there's always a but, right.
well, yeah, with higher returns comes more risk.
Okay, so what kind of risks are we talking about?
The value of your investments can go up and down. That's the market volatility everyone talks about.
Oh, yeah.
So you could actually lose money.
Oh.
And it's not always easy to get your money out of investments quickly.
I see. So it's less liquid than savings.
Exactly.
So before we even start thinking about investing, what are the essential things we need to have in place?
The document is really clear about this.
Okay.
You need a solid financial foundation.
What does that actually mean?
It means taking care of a couple key things first.
Okay, what's the first one?
You absolutely have to have an emergency fund.
Okay, so how much money are we talking about here?
Aim for enough cash to cover 3 to 6 months of your essential living expenses.
Wow, that seems like a lot.
It might seem like a lot,
Yeah.
but trust me, it's crucial.
Why is it so important?
Because unexpected stuff happens,
True.
like losing your job,
Oh, yeah.
huge medical bills, your car suddenly breaking down,
Ugh, hate when that happens.
right? Having that emergency fund keeps you from going into debt or having to sell investments at a bad time just to cover those expenses.
So it's like a safety net for your safety net.
Exactly. It's peace of mind.
Okay, that makes a lot of sense.
So once you've got that emergency fund in place,
Okay.
what's the next step?
What is the next step?
It's tackling any high-interest debt you have.
Oh, yeah, like credit card debt.
Exactly. Credit cards are the biggest culprit.
So why is paying off debt so important before investing?
It's all about the math.
Okay.
Let's say you're trying to earn 7% return on your investments,
Right.
but you're paying 18% interest on your credit card.
Ooh, that doesn't sound good.
It's not, you're losing way more money to interest than you're gaining from investments.
So paying off debt is like a guaranteed return on your money.
You could say that.
Okay, that makes sense.
Once you've got that high-interest debt under control,
Yeah.
then you can start thinking about other financial goals.
So what kinds of goals are we talking about here?
These are the things that are a little further out than immediate needs,
Okay.
but still within like a 1 to 5 year time frame.
So like what kind of things?
Like saving for a vacation,
Oh, yeah.
a down payment on a car,
Mm-hmm.
maybe even starting to save for a house down the road.
Oh.
For these shorter-term goals, it's all about keeping your money safe and easy to access.
So sticking with saving makes the most sense here.
Yeah, you don't want to risk losing money you'll need soon.
Makes sense.
This is where the stability of savings accounts really shines.
Okay, so we've talked about why saving is important, but
Right.
when does it really become like the main priority?
The document gives some specific situations.
Okay, I'm all ears.
If you need cash right away, like for a job loss,
Yeah.
unexpected medical bills,
Mm.
or that car breaking down,
Right.
then having a healthy savings account is a lifesaver.
Yeah, that makes sense.
It gives you that flexibility you need when things go wrong.
And what about people who aren't comfortable with risk?
Oh, yeah, that's another big one.
Like people who get stressed out by the stock market going up and down.
Exactly. For those folks focusing on the safety and predictability of savings might be the better option.
It's all about peace of mind, right?
Absolutely.
And what about those bigger expenses we talked about?
Right, like buying a house or paying for college.
Yeah, if those are coming up within the next 5 years or so, it's probably best to keep that money in a safe and easy to access savings account.
Yeah, you don't want to risk losing that money right before you need it.
So that covers saving pretty well, I think.
Yeah.
But now let's switch gears and talk about investing.
Sounds good.
So when does investing become the more important strategy?
The biggest factor is time.
Okay.
When you're investing for a long-term goal, like retirement,
Yeah.
especially if retirement is more than 10 years away,
Mm-hmm.
that's when investing starts to make a lot of sense.
So the further away your goal is, the more time your investments have to grow.
Exactly. And to recover from any dips in the market.
Makes sense.
And remember how we talked about inflation eroding the value of savings?
Oh, yeah.
Well, investing is a way to try and stay ahead of inflation.
Because investments have the potential to grow faster than inflation.
Exactly.
Yeah.
You're aiming for growth that beats the average inflation rate, which the document says is about 3% per year.
Okay, and we talked about risk before.
Right.
So if someone's okay with a little bit of risk
Mm-hmm.
and they're in it for the long haul, investing seems like a good way to potentially grow their money more significantly.
Exactly. It's about taking advantage of those higher potential returns.
But it sounds like most people aren't just doing one or the other.
Right. It's not usually an either-or situation.
Yeah, it seems like a combination of saving and investing is probably the best approach for most people.
I agree. For most people, a balanced strategy with both saving and investing is the key to financial success.
So it's like a hybrid approach.
Exactly.
That makes a lot of sense.
And the document even lays out like a suggested order of operations for this hybrid approach.
Oh, cool. Okay, what's the first step?
First things first, you got to build that emergency fund.
Right. Those 3 to 6 months of living expenses.
That's the foundation.
Got it.
What comes after that?
Then you want to look at tax-advantaged retirement accounts.
Like, what are some examples of those?
Things like a 401k through your employer
Okay.
or an IRA, an individual retirement account.
So those are good because they have tax benefits.
Huge tax benefits. You get deductions on contributions.
Nice.
Or tax-free growth.
So it's like a bonus for saving for retirement.
You could say that.
Awesome.
Okay.
So what's next in this hybrid approach?
Once you've maxed out those tax-advantaged accounts,
Yeah.
the document suggests using regular taxable brokerage accounts.
Okay, what are those for?
Those are for your mid to long-term goals.
So like 5 years or more in the future.
Exactly. You've got more flexibility with those.
Okay.
And you can still aim for growth. Gotcha. So where do high-yield savings accounts fit into all of this?
Those are still great for shorter-term goals.
Like that 1 to 3 year time frame we talked about.
Yeah, exactly the stuff you'll need relatively soon.
So you're not risking that money in the stock market.
Right.
The document gives an example of how someone might split their money between saving and investing.
Oh, yeah. What's that?
They suggest maybe 50% for savings,
Okay.
30% for investments,
Mm-hmm.
and then 20% for paying off debt or for discretionary spending.
Okay. But that's just the starting point, right?
Absolutely.
Everyone's situation is different.
Exactly.
Your own percentages will depend on your goals, your risk tolerance,
Yeah.
and how much money you have to work with.
So what are some of the key factors that can influence this balance between saving and investing?
The document highlights a few important ones.
Okay, like what?
Age is a biggie.
Okay, how does age play into it?
A younger person has more time to recover if the market takes a dip.
Because they have more time until retirement.
Yes, exactly. So they might be more comfortable taking on more risk,
Makes sense.
maybe putting a bigger chunk of their money into stocks.
Okay, what else matters?
Your income stability is huge.
So like someone with a steady paycheck, they might be more likely to invest aggressively.
Right, because they know they have money coming in regularly.
But someone who's self-employed or whose income fluctuates,
Yeah,
they might want to keep more money in savings just in case.
exactly. They
Oh.
need that safety net.
Gotcha. So it's all about finding that balance between risk and security based on your situation.
Exactly.
And the document also mentions that things like interest rates can play a role.
Oh, yeah, for sure.
Like if interest rates are high,
Mm-hmm.
savings accounts and CDs might start to look more appealing.
Right, because you can earn a decent return without taking on any risk.
But when the stock market is doing well,
Yeah.
people might be more inclined to invest in stocks.
It's all about weighing your options and seeing what makes the most sense at the time.
So let's say we have a good idea of what our balance between saving and investing should look like.
Okay.
What are some practical tips for actually making it happen?
Well, the biggest one is automation.
Oh, yeah, I've heard of that. What is that exactly?
It means setting up automatic transfers from your checking account
Okay.
to both your savings and your investment accounts.
So you don't have to think about it every month.
Exactly. It's like setting it and forgetting it.
I like that.
It's a great way to make sure you're consistently saving and investing.
Makes sense.
Yeah.
What else should we be doing?
Diversification is key, especially for investments.
Okay, so what does that mean exactly?
It means spreading your money across different types of investments.
Okay, so not putting all your eggs in one basket.
Exactly. The document mentions things like stocks,
Yeah.
bonds,
Mm-hmm.
and REITs, which are real estate investment trusts.
So you're not too exposed to the ups and downs of any one investment.
Right. It helps reduce your overall risk.
That's smart.
And one more really important thing.
Okay, what's that?
You have to review your financial plan regularly.
Oh, yeah, like once a year.
Exactly.
Why is that so important?
Because life changes.
That's true.
You might get a raise.
Yeah.
Your family situation might change.
Mm-hmm.
Your plans for retirement might shift.
So you need to adjust your savings and investment goals as you go.
Exactly.
Yeah.
Keep things aligned with your current situation.
So the big takeaway here is that saving and investing aren't enemies.
No, they're not.
They're more like teammates working together.
Right. They both play an important role in your overall financial health.
So saving is about protecting the present.
Yeah.
And investing is about securing the future.
Yeah, that's a great way to put it.
The document uses the example of a 25-year-old and a 55-year-old.
Oh, yeah. What about them?
They're saying the 25-year-old might focus more on stocks.
Because they have more time until retirement
Exactly.
and they can handle more risk.
But the 55-year-old might shift towards bonds and cash.
To protect their savings as they get closer to retirement.
Makes sense. So it all comes down to aligning your financial strategy with your goals,
Mm-hmm.
your risk tolerance,
Yeah,
and your time horizon.
exactly. Finding that personalized balance is key.
So for all of you listening out there, what does your ideal balance look like?
Right. Think about it.
What are your immediate needs?
Yeah.
What are your long-term dreams?
And how can you use saving and investing to get there?
That's the question we all need to be asking ourselves.
I agree. It's the path to financial well-being.
If you found this discussion informative, please like, subscribe, and share this channel to get daily discussions on a current economic topic.